What's up, everyone? It's Cowdy with Money Vesting. Welcome on board for another live stream here. So we've got Jerome Powell's speech happening in less than an hour, and that's when he's going to start. The FOMC statement comes out in under 20 minutes. If you guys can see me, hear me, just give me a thumbs up. Just want to make sure the audio and the video is working well. Also participate in our poll. We've got a poll going on right now. So again, it's going to be quite interesting. 20 minutes left to go for the FOMC statement and under an hour for the actual Fed press conference, the FOMC meeting as well. So thank you so much for joining in. Again, I am going to be staying up late to do this, so I really appreciate it. All I ask from you guys in return is drop a like and also share this stream with other folks who may want to participate and, of course, join us for this live stream as well. So that's all I'm asking. Again, it's going to get pretty late over here. It's going to be past midnight, almost 1 in the morning. So I really appreciate your guys' support. Again, all I'm asking is a drop in the like button down below. Of course, share this stream with other folks as well. So thank you so much for joining. Really appreciate it. And again, market is just really trading sideways. We're seeing a lot of consolidation and just a lot of sideways action in the markets prior to the actual statement release and the FOMC press conference as well. Microsoft continues to accelerate a little bit to the downside. It's down a little bit over 4.5%. So trading at 334, 335. So we're definitely seeing a little bit of that momentum lower below that 21 EMA. And I think it's going to get down to 322 over the course of this week, maybe next week as well. So it's going to get, again, quite interesting. And Google here up a little bit over 5.75% on the back of earnings, but again, getting rejected at close to $131, $132 per share for Google as well. So we're seeing a lot of resistance at those levels for Google. So let me know what you guys think. 31 votes only. We want more participation. We got over 60 people watching. Just participate, vote. What do you guys think? 25 basis points, no cut, no hike, or 50 basis points. There's 9% people expecting 50 basis points right now. And of course, majority of people expecting a rate hike, which is exactly what we have over here based on the probability outcomes. Again, there is over a 96% chance that the Federal Reserve is going to raise rates by 25 basis points, keep them there for longer, so keep them there till March of 2024, and then of course start cutting rates all the way down to 4.25% as well. Now, market valuations, as we have already talked about from an S&P perspective, we are at a little bit over 19.5, closer to 20 times earnings multiple, which if you basically do the math here, 1 divided by 20 is going to be a little bit closer to about a 5% yield on earnings. So that's very comparable to the 10-year yield. So the 10-year yield right now is a little bit over 3.8%, maybe not so comparable, but definitely up there. And obviously, if prices continue to increase, if we do see a little bit of an increase in overall prices and earnings don't increase as fast, then that's obviously going to lead to a lower yield and higher price earnings multiple as well, which again, eventually is going to be comping against the 10-year yield as well. So X2DAB says, I just bought calls in Chipotle, buy puts because I'm always wrong. So again, it's trading prior to these type of binary events, it's very much of a gamble. So you got to be really careful with what type of trades you end up taking, because again, when you are trading into these binary events, they can go either way, right? Nobody really has any sort of a guarantee or certainty as to what the market's going to do. Like, you can know exactly word for word what Jerome Powell is going to say, and still not know how the market's going to react or how we're going to move after the press conference happens, right? So that's the nature of the market, because market prices in different types of information at different times, through different mediums. So that's just the chaotic nature of the market. So it's much better, in my opinion at least, to be trading after these events are over. So after Jerome Powell comes out with the press conference, after the statement's released, trading on that market volatility, depending on what actually ends up happening, then you can set up a good trade idea. But of course, going into these events like earnings and FOMCs and other types of macroeconomic events, it becomes very much of a gamble, in my opinion. And do straddle work in such situations, Shang said. So that's actually a good idea as well, but only do straddles if you know the implied volatility and you understand the expected move in the market, right? Because if you are creating, let's say, a straddle and you are expecting the market to actually break out or break down a certain level, But if it doesn't, if it stays within that range, well, guess what? You lose your premiums, and of course, you end up losing that debit, whatever you paid. But of course, if it breaks out or breaks down out of that range, then of course you end up making money. Of course, depending on your puts and calls, one of them will expire out of the money, one of them will expire in the money. And the idea would be to make a profit on one of those trades. That's what the whole point of straddle is, to make money in either direction. But again, you got to understand expected volatility, just implied volatility, and of course, understanding that move in the market. So, all right, let's see if you have any questions. Well, facts, I lost both my day trades today. I did everything you said not to do today. Yeah, so got to be careful with these type of situations and these types of days where, volatility definitely is a lot higher. And right now we're seeing the markets pretty much trade sideways, so it's not really doing anything. NASDAQ is still down over 46 basis points. The Dow is flat, and the S&P is about 26 basis points, with the yields just a little bit under 3.9. And of course, a lot of individual stocks are just really trading sideways, with Microsoft and Google kind of moving in opposite directions. So got to brace ourselves. We'll see if this is indeed going to be the last and final hike from the Federal Reserve, or if they are going to guide for potentially even more hikes later down the road. So yeah, if you have any questions about the economy, earnings, valuations, individual stocks, just let me know. I would prefer a little bit more macroeconomic related questions, because that's really what it's going to come down to. Because at the end of the day, we're here. Monetary policy is part of the macroeconomic cycle, and what the Federal Reserve ends up doing kind of fits perfectly with our macroeconomic analysis. But again, if you have any questions about individual stocks as well, happy to go over those. David, thanks for staying up late for us, Caddy. Come on, peeps. 86 people watching, but only 25 likes. Hit that like button. Yes, so really the only thing that I ask from you guys is just hit that like button, share this stream with other folks that may want to join us to listen in on what Jerome Powell has to say. And in under 13 minutes, we've got the press conference. We've got the statement. The press conference is at 2:30. But 2 p.m. is the Federal Reserve statement, which is going to be released over here for July 26th. There is no SEP, so no summary of economic projections. So as soon as we get that statement, the first thing we're going to look at is what is going to be that target range for the federal funds rate. And you can see that this is from the previous report in June. They raised rates to 5 to 5.25%, so 5 and a 5.25%. So if this number increases to 5.25 and 5.5, that's when you know that they raised 25 basis points. If this number goes up to 5.5 to 5.75 percentage point, then that means they raised rates by 50 basis points, which obviously the probability for that is really, really low, only a 3.5% probability. But that could be a huge shock to the market if the Federal Reserve obviously ends up doing 50 basis points, which I don't believe the Federal Reserve will do. And again, this is going to be that stream. It's going to take some time. Again, started streaming 12 minutes ago, and we still have a little bit under an hour before the press conference actually begins. So we'll be waiting for that at 2:30 p.m. Eastern as well. So yeah, that's where we are. Make sure that you also participate in the poll. We've got the votes going on, 107 votes right now. So make sure that you do participate in that as well. 75% people expecting 25 basis points, 14% of you expecting no hikes, and 8% of you expecting a 50 basis points. 3% of you are definitely very dovish, expecting Jerome Powell to cut rates. It isn't difficult to hit that like button, guys. Let's not be stingy. Yeah, thank you so much. I appreciate that. And good morning from Melbourne. Jonas, thank you so much for joining us. It is actually going to be super late over in Melbourne, is it not? What time is it in Australia right now? Oh, it's actually going to be super early. Yeah, so you guys are definitely way ahead compared to the entire world. Yeah, so 5:45 in Auckland. Guessing it's going to probably be the same in Melbourne. 3:50 a.m. So, okay, it's an hour behind Auckland, Australia. So, yeah, I mean, it's crazy. Like 4 in the morning, that's dedication right there. I would not want to wake up at like 4 in the morning and do these live streams. When I was in LA, obviously it was super early, and I remember doing an inflation live stream, which was at 5:30 in the morning, which I guess isn't too bad. Like I usually do wake up at 5:30 in the morning anyway, but when you are jet lagged, you are tired, there's just no chance. But 4, 3, I mean, that's just crazy numbers right there. Like I wouldn't want to wake up at that time to be doing live streams there. 6:45 in the UK. Yep. So 6:45 p.m. That's the ideal time. UK definitely is in the best time zone, I would say, out of everything, because it's kind of like in the middle of the world, and you've got you've got perfect opportunity in the UK. When I was there, it was literally the perfect time zone to trade and start your day by trading the Indian, Asian markets, Chinese markets, and then you go into trading the UK market, European markets, and then you can finish off your day by trading the US market. So you've got the best of all worlds. You start at 6 a.m., you end at 10 p.m., and you've got a whole 16-hour day to trade all markets all over the world. And it's all during the day, right? You know when you're sleeping, all markets are pretty much closed during that time. Maybe except the Australian market. But again, who's really trading the Australian market? Yeah, best time to be at the gym as well. Where are you traveling to next? So I am going to Dubai this weekend. So I will be there for a couple of weeks. If anybody's out there, just let me know and we'll set something up. I'm already planning to meet with a couple of people. So that should be exciting. And yeah, super excited for that. Is that California? No, we were talking about the UK. We're talking about London, to be precise. Which I believe to be is very, very good time zone wise. And also in terms of the proximity to where everything is, like, a couple hours, you can be in Europe pretty much anywhere. 6-hour flight to New York, 8-hour flight to New Delhi, maybe a 10-hour flight to Beijing, and of course a longer flight to Australia. But you are very, very close, like one flight away from pretty much everywhere. But of course, if you're traveling from Asia to the US, or North America, you've got to lay over somewhere, whether you're traveling west or east, you've got to stop somewhere. There's very few direct flights. Even if there are, they're like 18-hour, 20-hour long flights. So it is, like I said, the UK probably like the best proximity-wise and time zone-wise. Definitely a much better place. But anyway, so going back over to the markets and monetary policy and macroeconomics, because that's really what we're here to discuss, not different countries. But like I said, yields are pushing higher a little bit in anticipation of this potential rate hike. So we have moved higher. In the last couple hours, we pushed up a little bit over 1%. Markets are just trading sideways. NASDAQ is still lower from yesterday's close. S&P is flat. The Dow is very, very flat, about as flat as it can get. The Dow is on a very hot streak, 12 consistent green days for the Dow Jones. It's trading back over 35,400. And of course, a lot of individual stocks are also trading very flat, except for Microsoft and Google, which are the two companies that reported earnings. And of course, Meta is going to report earnings after today's close. So 8:51 p.m. in Kuwait. Yep. So again, Kuwait, Dubai, UAE, they're all going to be probably on the same time zone almost. So they're a little bit behind compared to New Delhi. But like I said, this is going to be the first thing that comes out at 2 p.m. Eastern. That's what we're going to look at. And then, of course, we'll jump over to the press conference 30 minutes later, which is going to be, again, Jerome Powell and a lot of Q&A from the media as well. So if you take a look at our poll, again, do participate. We've only got 181 votes. I want to see us get to at least 400 votes, if not more. So let us know. What do you think? 25, 50, rate hike, rate cut. If you haven't participated, definitely do vote. So yeah, Barbie movie, 3D Barbie animation right next to Burj Khalifa. That's crazy. Question: the market is being propped up by over 10 stocks. Yes, broad market is up, but less than 10 are pushing it higher if and when the rug pull occurs. Question: do you see these 10 stocks getting hit the hardest, or do you think it'll be broad market hits, keeping these 10 stocks still elevated? So that's actually a good question. We've already talked about the market being up based on these magnificent 7. So it's really just 7 to 8 companies that are that are higher, up like 40, 50, 60%. Some of them are up like hundreds of percent year to date. Of course, we were talking about these big tech companies. But remember that matrix that I shared with you guys where we talked about how if technology keeps pushing higher, markets is going to be slowly and steadily grinding its way higher. But the moment technology starts pulling back, then it's all going to come down to what other sectors actually end up doing. And if other sectors start rallying, then the market might be slightly down or flat moving forward. And that's specifically for the NASDAQ, right? It all depends on market weighting as well. So as you have seen over the last 1 month, we've seen what? Technology has significantly underperformed in the last 1 month. So if you come over to XLK, you'll notice that even though it is up in the month of July, 85 basis points, that is nothing compared to, let's say, materials that is up 2.5%. Or XLU, which is utilities, that is up 4.6%, right? And if you come over to financials, that is up a little bit over 5%. And then if you come over to industrials, XLY, it's up a little bit over 2.6%. If you come over to staples, maybe, if you take a look, it's up a little bit over 2.5%. So you get the idea. XLK, which is technology, mostly technology driven, is down, and SMH is up 1.29%. So these sectors have underperformed in July. They have underperformed. They have not been able to keep up with other parts of the market, which is the value stocks, which are the dividend stocks, which are the industrials and utilities and financials and energy. Even XLE is up on the month, pretty substantially up over almost 6%. So you can start to see how the market positioning is changing a little bit away from tech over to more defensively. That's exactly one of the reasons why I mentioned that the second half of this year is going to be very different than the first half. Now, that is not to say that the technology stocks are going to start selling off. No, I think it's just a little bit of new money entering into more defensive parts of the market. And maybe there's a little bit of rotation happening, but we're seeing this rally broaden out a little bit. And of course, especially the S&P and the Dow, they're pushing higher. NASDAQ is seeing a bit of a pullback and a dip. So that's where we are, and it all depends on whether these technology stocks get aggressively sold off. I think some of them are long overdue. Like, so for example, Nvidia. I could argue that Nvidia is long overdue for a pretty steep potential pullback. Again, time will tell if that actually ends up happening or not. Tesla, it did see a bit of a pullback. This month it's down, actually still green, but barely, up 74, 75 basis points. And it's got, like, last couple of months of very strong rallies, up 24%, 20%. So in these 2 months, it was up over 71%. So it isn't really like due for a significant pullback, but yeah, sure. We can see some consolidation. That's exactly what we're seeing in July. And then other than that, I think Netflix is overdue for a bit of a pullback. It's seen just straight up 179% move, and so is Meta. Like, you can see, like, literally look at this chart. Meta for the last 8 months, 9 months has not seen a single red month. It's all like it's literally just seen a V-shaped recovery back higher. So yes, I could argue that maybe some stocks are overdue for a bit of a profit taking, but other sectors are participating. Other sectors are moving higher. They're definitely seeing a lot of momentum to the upside for those. So also our stocks are down today. In sympathy, Enphase is reporting earnings tomorrow. Can you speculate on Enphase earnings? Are you still buying TMF? So David, I think TMF for me is again going to be a little bit more of an intermediate to longer term play. I know that a couple members mentioned, somebody mentioned TMF has been dead, and that's partly because it's not the time yet. It is not really the time for TMF to be moving because rates are still going higher. All right, and we're going to get that another rate hike today, 25 basis points. We'll see how TMF moves on that news, but eventually we will find ourselves in a situation where the Federal Reserve is done. They're done with hiking. That's going to be the potentially last hike, maybe the next one, or depending on the situation. Eventually, there will be a time where they are done raising rates, and then once they start cutting rates, that's when I expect TMF to start moving higher, and that's when the yields also are expected to come down. So it is going to be a patient play. Like, this is not something that it's kind of like in the back burner. I've got a couple hundred shares, nothing crazy, just for me to keep track of this position, and will eventually dollar cost average and buy more if and when I do believe the time is right to be looking into some positions in the bond market. Now going over to Enphase fairly quickly here, because we've got the report coming out in under a minute. 3% down. It was higher, it was down a little bit over 5%, so getting bought up here intraday. So green candle on a red day definitely does suggest there's lots of buyers stepping in for Enphase. And of course, resistance going to put it roughly around 189, 188. So those right there are going to be some levels to watch. Okay, so we are going to switch over. We've got the S&P over here. We've got the NASDAQ and the Dow Jones. We've got less than a minute, folks, for that report to come out. Make sure that you do participate. Vote. 30 seconds left. And we'll take a look at the report here. Again, as soon as it comes out, we will find out what the plan is with the Federal Reserve. So we're going to go over to meeting and calendars, and boom, this is where it should appear right at 2 p.m. Eastern. So in under 20 seconds now, we are going to reload and take a look at how the market's also reacting to that report. So we're going to switch over to the 5-minute chart here for both of them, and we should be good to go. We'll take a look at the yields and the dollar index as well. So let's see. Let's reload. Takes a bit of a time here. There we go. So PDF and 5.25% and 5.5%. So 25 basis points, that's exactly what we got. The NASDAQ here is not reacting all that much. We'll see how the markets move in the next few seconds. But yes, we did get 25 basis points. So they raised the committee federal funds rate to 5.25% and 5.5%. So 5.25 to 5.5%. And the committee will continue to assess additional information and some implication of monetary policy in determining the extent of additional monetary policy firming that may be appropriate to return inflation 2% over time. The committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, inflation, and economic and financial developments. In addition, the committee will continue to reduce its holding of treasury securities and agency mortgage-backed securities. Let's see, in assessing the appropriate sense of monetary policy, committee will continue to monitor the implications of incoming information, economic outlook. And let's see, we've got NASDAQ recovering a little bit. That's exactly what we were expecting, 25 basis points from the Fed, and that's exactly what we got. The U.S. banking system is sound and resilient. Tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation, and the extent of these effects remains uncertain, and the committee remains highly attentive of inflation risks. So that's about it. 25 basis points is what we got from the Federal Reserve. And that's exactly what the market was also pricing in. But again, the real question is, what is the Federal Reserve going to do moving forward? Next meeting, right? It's always about the guidance. That's what the market wants to know, because we basically just got what the market was expecting. So there's not going to be a lot of surprises there. All right, so now I'm going to start a new poll. Since we've got more people joining in, I'm going to start a new poll, and I want everyone to participate. I want all 400 people watching to participate in that poll, and that is going to be asking you guys a simple question. Will there or will there not be another rate hike in 2023? I can't end this poll. I don't know what's going on here. Let me just reload this. All right, so we're going to end this poll, and I'm going to start a new one. So another rate hike. Now, how many rate hikes in 2023? How many more? How many additional? Let's do how many additional rate hikes in 2023? We'll do 0, 1, 2, 3. Okay, because we only really have, how many meetings do we have left? We've only got 3 meetings: September, October, November. That's like 1 meeting in December. So we only got 3 meetings left. So 0, 1, 2, 3. That's going to be the poll. Participate, vote, and let me know what you think is going to be that number of additional hikes left in 2023. This is after today's hike. This is not including today. This is after including today. Excuse me. This is after including today. So moving forward, remaining 3 meetings, are they going to do no hikes, 1 more, 2 more, or 3 more? And just to clarify, the Federal Reserve has already mentioned 1 additional hike. Okay, they've already mentioned in their SEP, the Summary of Economic Projections. So if you come back to this statement from previous June meeting, come down here, you'll notice that their guidance was 5.6%, right, for 2023. 5.6% was their guidance. Where are we right now? 5.5. Okay, so we're 10 basis points short of what their own estimate was for 2023. So that meaning they've already mentioned it to us that they're going to raise rates to 5.6%, meaning 1 more potential hike is what they're expecting, and then cuts all the way to 4.6. That's 100 basis points cuts. 1 cut is 25 basis points, so that's 4 cuts that they're pricing in, and markets right now pricing in 5 cuts all the way down to 4 to 4.25%. So a number far below than what the Federal Reserve pretty much guided us for. So that's what the Federal Reserve has guided us. Again, I want to hear from you guys. So let me know in the poll what everyone else thinks, and whether we're going to see 0, 1, 2, 3. Right now, 1 more, 49. So half of you expect Federal Reserve to raise rates by at least 25 basis points more. And yeah, so very, very non-reactive market. So I think because we basically got what we were looking for. So it was just the consensus, 99% probability that we're going to see. I think if going into this statement, if there was a wider dispersion of consensus, meaning that 60% were expecting 25 basis points, 40% of the market was expecting no hikes, and then we got a 25 basis points, I think you might have seen a much bigger move in the market. But since this was such a broad consensus, 99% probability that the Federal Reserve is going to raise rates, and that's exactly what we got, you're not seeing the market move all that much. because we literally got what we were expecting. Majority of people, 99% of people were expecting. So that's why it's a very non-reactive move from the market. And like I said, if there was like a wider dispersion in the probability outcomes, 40-60, 50-50, 70-30, even 80-20 might have moved the markets a little bit more. But then since it was 96.5%, not a lot. So I think that really it's really going to come down to what Federal Reserve ends up saying, what Jerome Powell ends up saying in under 30 minutes now. So yeah, if you have any questions, feel free to ask more specifically on the macroeconomics. I would love to address those. And lots of people saying one more rate hike. How much is it? So we raised by 25 basis points MP. Inflation seems pretty tamed, and I see housing developments all over the U.S., so home prices are destined to come down. David says, so yeah, I've been reading a couple reports as well that home prices definitely are slowing down a little bit. They are not, well, they're still, I would say, in some parts of the market, and of course, we've seen 3 consecutive months of year-over-year declines in home prices. But of course, some markets are still hotter than others. So on an aggregate basis, yes, we are definitely slowing down, and the rate of increase has slowed down as well. Can we take a pause? I'm having to shower and be back in 10. Go ahead, man. I mean, Jerome Powell doesn't start talking here in any time soon, so you've got 24 minutes to go shower and come back. Still got high inflation here in the UK. So yes, UK inflation's pretty brutal, no doubt. Still over 8%, 9%. And I think Andrew Bailey's mentioned that the recession probabilities have come down dramatically. And of course, inflation expectations are still pretty elevated, but they are expected to come down eventually as rates continue to go higher. And they also did surprise us with couple hikes put together, so like 50 basis points last hike, I remember, is what they did. So they're expecting to once again raise rates moving forward to bring inflation down. Which tool can you see all those charts? So this is TradingView. TradingView is a platform that I've been using for a very long time. There is an affiliate link if you want to join TradingView. And again, it's been a service I've been using for like 7-8 years. It's probably one of the best out there. A lot of the brokerages do have their own charting software, but I just never really got used to it. And this has everything that I really need from a technical analysis, fundamental analysis, quick analysis standpoint. Created my own watch list. A lot of really cool features, strategy testers, Pine Editor, a lot of things that you can do. Yeah, thank you for the information, King Glory. Thank you so much for joining. I really appreciate it. And coming to India to watch the World Cup cricket in Ahmedabad in October. That's great. That's awesome. Hopefully we can meet then. But yeah, overall, Tesla is still down. Nvidia is still down. Microsoft still down. Apple still down as well. Or Apple is slightly higher, so up 42 basis points. A little bit of that momentum back to the upside. We're going to do a little bit of an audio check later, just to make sure that you guys can see and hear the conference. Again, which starts in under 20 minutes now, and then we should be all set. Ian, thank you so much. I appreciate that. That's not weird at all, my friend. That's not weird at all. So what do you think about Chinese stocks? Can they recover in 2023, 2024 like BABA, 250, 300? So, I think there's always going to be a little bit of that geopolitical risk with the Chinese stocks, even though it has de-risked a little bit because the regulators have mentioned that they're no longer going to be focusing on individual companies, but instead on overall industries. So that is good news for companies like Alibaba, Baidu, JD.com, like Tencent, that have just basically, they're not in the microscopic sort of pressure with the Chinese government and the regulators, but as an industry, they're still going to be regulated. They're still going to be overseen from that perspective. So I wouldn't necessarily believe that Alibaba's got the potential to go back to 250, 300 because of that geopolitical risk. Maybe to 105 and 125, 130 is the potential resistance levels and next targets to watch. But then, of course, long term, I mean, Alibaba does trade at a pretty significantly cheap valuation here compared to its peers, especially compared to its U.S. counterparts. So I would say 105, 128, some of the initial levels to watch for Alibaba. Okay, so Teladoc tomorrow or so, I think 3 earnings back was a full disaster. Nothing could have been so great now, minus Kathy Wood being bullish on it. So yes, I'll take a look at Teladoc as well. soon. Fernando Helicati, thanks for all the hard work. If possible, any comments on RH Restoration Hardware? So we'll take a look at it very quickly. Wow, very strong move. Retail trade, market caps over 8.5 billion. Volumes looks like it's pretty decent. Very, very overbought right now, no doubt. So it's moved up quite a bit, up over 68%. Looks like it is a pretty consistent business. So revenue earnings seem to be very stable, but 2023, there is expected to be a huge compression in earnings, 50% compression, and then it's expected to start increasing once again and not get back to the same earnings until 2026. Same thing with revenue, expected to come down quite heavily. When you take a look at the balance sheet, they are sitting on a little bit of a net debt and valuation-wise, trading at 27 times earnings, 21 times cash flow. So for me, 26, 27 times earnings, a bit too much for a company that's expected to decline in earnings 50%. And of course, technically it is overbought. So it's going to be a hard pass for now, but something that we may want to look into later down the road if and when the earnings, once again, recover, balance sheet improves, and we can see some oversold levels, some good deals, some support areas for this company. So hopefully that gives you a little bit of that perspective there. Let's see. Enphase sold puts today morning at the drop. Hopefully it doesn't tank tomorrow or will take assignment under 150. What's your target price for Enphase? So yes, so Enphase, I think 150 is going to be pretty decent. I would say 144 is really what my fair value is, my buy target. And since I want to buy companies that are below my intrinsic value so that they're undervalued, so to speak, based on the fundamental analysis, support level is going to be in the 120s. That's going to be a potential good deal area for Enphase as well. So that right there is going to be that support level to watch for Enphase. And of course, resistance all the way up to 188 for the company as well. Tomorrow's earnings, I think, are going to be quite interesting because expectations are high for Enphase, $1.28 and $725 million in revenue. That, again, is going to be a pretty significant increase year over year. I think 37% earnings growth and over 50% revenue growth for the company. So, that is expected to be pretty strong. If they miss even slightly, if they come shy of expectations or even the guidance doesn't match up with what analysts are expecting, yeah, you can expect Enphase to drop like 10, 12, 15% easy. I have no doubt in my mind if they miss guidance, they're going to be in the 150s tomorrow because of the expectations being so high. But that fear is going to be a bit overblown. So that's exactly what happened last earnings. They reported some stellar growth numbers, and yet the stock price was down. And I think something very similar is possible for tomorrow as well. So Enphase will report earnings after the markets close. So they're scheduled reporting after the markets close. All right, let's see. So Mara Prospects Future, again, Bitcoin is going to be the one to watch for. Marathon, Riot, CleanSpark, a lot of these Bitcoin mining, crypto mining companies. It's really going to come down to Bitcoin. And I have no idea where Bitcoin is going to be 10, 20, 30 years from now. I'm going to be brutally honest. There's no way for me to calculate the intrinsic value, the fundamental value for Bitcoin. It's pure demand supply dynamics here. If there's a lot of demand, little to no supply, because supply is going to be limited, then Bitcoin obviously is going to rally 30, 40, 50,000, and you will see a lot of these crypto mining companies also rally well and push higher. But if it doesn't move much, well, then that's about it. So Ian, do you still buy stocks if they never go to your fair value? Sometimes I do. I've got a flexibility range, right? So I've got a plus minus 5%. And that's the whole idea behind having your fair value, right? These fair values, these intrinsic values are not set in stone. Like they're not to be followed to the T with decimal points. Like it's not like if my fair value is on Enphase at $144.37, I'm going to buy it exactly at the level. No. There is flexibility because markets are not that precise. They're not precise in the way they trade. They are chaotic, and just the nature of the market is very, very, flexible, so to speak. It's chaotic because things change, right? Things change every day. So we've got a flexibility range where we look at plus minus 5%. But the fair value is there to kind of give you a good foundation, right? Because think about what we are looking in when we are calculating our fair value, right? When we are putting in our intrinsic values on individual stocks, when we are doing our fundamental analysis, we're going with a conservative growth rate. So we're going with a growth rate that's below the consensus, right? Whatever the analyst consensus is, we're going with far below, more conservative growth rates. We're going with a PE multiple, which is usually, not always, but most of the times, if you guys watch my videos, is lower than where the price is trading right now, right? So if Enphase is trading at 32, 35 times earnings, I'm plugging in 25 or 22 or 20, right? Because I expect as companies grow, right? Look what happened with Tesla. Tesla 2 years ago was trading at over 1,000 times PE multiple. Where is it today? 50. And I can tell you right now, where is it going to be 5 years from now? Closer to 25. Same thing happened with Apple. Same thing happens with a lot of these big tech companies. Same thing will probably happen with Nvidia as well. Right now, 40 times sales. I can tell you 5 years from now, most certainly not 40 times sales. If it continues to trade at 40 times sales, it'll be an anomaly. It'll be in its own rare category. But most of the times, as numbers grow, as numbers get bigger and bigger, multiples compress. And that's why, going back to our fair value, we go with a multiple that's already lower than where the price is trading at. So we go with a conservative growth rate. We go with a lower multiple. We go with a higher discount rate. And to top it all off, we go with a margin of safety, right? So a lot of the times, the fair values that you actually see are not the true fair values, because those fair values already have a 10% room of error built in. If you remove that margin of safety, that's the fair value of the stock, right? But the reason I go with another 10% on top of an already conservative fair value is to give us even further layer of protection and a room for error. And on to top it all off, the goal is to buy stocks below the fair value. So you're getting them at an undervalued level, right? So you see how there's so many layers like built in when we're calculating our intrinsic value. That's why like people tell me like, your fair values are never going to get hit. They're like too low. You're crazy if you think the prices are going to get down there. It doesn't matter if the price gets down there or not. What matters is if it does, I'll be ready to buy it. That's the whole idea, right? It's not a prediction. It's a level to be a buyer at. That's the difference there. It's not a prediction that prices are going to get down there, but it is, if it gets down there, I'll be ready to buy it. There's like a subtle difference there when we calculate these numbers. And the cherry on top, the icing on cake, is what I like to call the best case scenario. So you're buying it with the most conservative, most bear case scenario, and the reality pans out to be the best case, most bull case scenario. And of course, your returns then end up looking like much better than what you originally anticipated. So that's the whole point, right? And that's why we have the intrinsic value spreadsheet, so that everyone can get a good gauge, a good foundation for all these companies, so that you can figure out, okay, this is where the fair value is for these companies. Now you can base off of, let's say that you want to sell puts, let's say that you want to buy, let's say that you want to, trim a little bit. What's the price target? What's the fair value? So it serves as a good foundation, so it's a good indicator on those things. So hopefully that gave you a little bit of a context as to what we look for when we're calculating our fair value. So how about MAA? So we have done an analysis on MAA as well, Mid-American Apartment Communities. I actually did a video on 4 REITs recently. I think last month in June, we talked about 4 REITs. Anyone remember those 4 REITs? Bonus question. I've already given away one. So MAA was one of them. There were 3 more REITs, if you guys remember it. Bonus points to anybody who remembers it. There were 4 REITs we talked about. So real estate investment trusts that are required to pay over 90% of their profits as rental income, or basically dividends. So Realty Corp was one. Yes, you're right. So that's 2. Realty Corp and MAA, that's Mid-American Apartment Buildings. And there were 2 more. 2 more. Let's see who gets it. Let's see who's actually dedicated in watching the videos and, of course, remembering the other 2. I'd be surprised if somebody comes up with those other 2. Oh, Yenser, there we go, Rosny. American Tower, yep, so American Tower was the 3rd one, AMT. Lot of infrastructure when it comes to 5G, IoT, this is definitely one to consider. 3.3%, very consistently growing revenues and earnings, as you can see. But there's one more missing, and probably one of my favorite ones, because it's got a lot of potential, lots of potential. You should make test days and give away 1 share of something for winners. Yes, I think that's a great idea. I think we can do that as well. Public storage. No, public storage is actually a stock. It's not a REIT. So Margaret says AMT and DLR. Yes, so DLR, Digital Realty, was the last one, which is basically storage space for cloud. All right, so data servers. So as there's going to be a lot of demand for space to host servers and to basically all these cloud services, Google Cloud, Amazon Web Services, Azure, they're going to need a lot of space to host their cloud services through data servers and whatnot. And they need a place to basically store it, right? So DLR basically offers that service. Again, you can see very consistently growing revenues and profitability. Their dividend yield is over 4%. It's been performing pretty well. So, we talked about it earlier in the month, but it's rallied over 43%. And I think since June, since we talked about it, it's up a little bit over 19-20% as well. So yes, those were the four that we talked about. Realty Corp, Digital Realty Trust, Mid-America Apartment Complex, and then what was the last one? Realty Income Corp. Enphase to the moon. So yeah, tomorrow is the big day. It is kind of, again, picking up here, giving basically recovering most of its losses from intraday, but still down close to 3% right now. Dimitris, hello guys from Greece. Man, I've always wanted to visit Greece. It's such a beautiful place. Athens, Mykonos, like I really want to go. It's on my bucket list that I want to go. So much history there too. So yeah, if you have any recommendations for what are the best times to visit, where to visit, I would love to know. Yeah, Meta earnings after hours, so they're going to be coming out later today with their earnings. But I think the more important piece for today is going to be the press conference from JP. Caddy, do you do your job or do you have another? No, so it's not really, I don't consider this to be a job at all. Like, I don't consider this to be work. It's something that I enjoy so much that it never really feels like work. So, yeah, most of the day I'm just like researching, analyzing, reading. That's most of my day. And of course, doing live streams and creating content. Cret is a must. That's good to know. Any good puts for Enphase? So if you take a look at the options chain for Enphase, if you're going for puts, 30 days out, again, a lot of it is covered in our option scores. By the way, I just want to point out that we do have a new option score, so you might be already seeing that up there. And right now it's 50% off until the end of this month. The coupon code is going to be launch if you want to have access to a whole library of lectures and videos and tutorials that go over risk management, teaching you how to trade options, selling options, generating cash flow, rolling out options, different Greeks, reading the options chain, looking at premiums, calculating return on collaterals, opportunity cost. There's a lot that goes into that course, so you can do your analysis. And it's a lesson. It's basically a skill that once you learn it, as your portfolio grows, doesn't matter when you trade, whether you're 30, 40, 50, 70, 90 years old, doesn't matter. It's going to be timeless lessons that you can pretty much generate cash flow, income for the rest of your life through your portfolio, through your cash by selling options. So that's something that if you're interested in, it's going to be up there. But looking at, puts for Enphase, we also talk about that in the course, what type of delta we want to go for, delta, gamma, theta, and of course, what type of open interest and how to pick your strikes, how to pick the right strike prices, because a lot of times people pick strike prices out of thin air and it just doesn't work that way. There's a lot of analysis that goes into picking the right strikes, and then of course, doing the calculation against the premium as well. But for me, I did have Enphase puts in the 140s that expired out of the money. We ended up making nice profits. And if I were looking at selling maybe puts once again on Enphase, I'll be looking at 140, 135, around those levels for 30 days out. So that's something that I would be looking at for Enphase. So 6 minutes, folks. 6 minutes. Share this stream with other people. Have them join as well. We've got 302 votes. We're waiting for maybe a couple hundred votes here so that we can get a good understanding on what the expectations are from the small data set that we have here in our community. But 47% of people expecting the Federal Reserve to raise rates by one more hike, basically 25 basis points. 27% expecting no hikes, and about 18% expecting 2, and then 9% the hawkish of the group, the hawks of the group, expecting 3 hikes or more. So, okay, and above, when you have to take a new position, do you have a percentage in mind that you have to buy it once, or do you buy in increments, or 10K, 5K as the price moves higher? I'd like to hear your approach. So it really depends on my conviction, right? So your portfolio allocation is a great reflection of your conviction, right? So if I ask you guys, right, everyone, just type in the ticker symbol of your highest allocation stock. Okay, what stock do you own that you have the highest allocation, whether it's 20% of your portfolio, 30%, 50%, whether it's 10%, 5%, what stock is your highest allocation in your portfolio? So what is it? UNH, 16%, Colby says, right? So Stanford says Tesla, 10%, Tesla. Deval Caddy, how to get in touch with you for general info. So there should be an email in the about section of the channel. So if you go to about section, there should be an email, or you can also get me in touch through Discord, or just email me and you should be fine. So there we go, right? Tesla, Microsoft, Amazon, Tesla, Palantir, Apple. Jolly's just joking here, TTCF. But the point is that these are stocks that are your highest allocation because they are your highest conviction companies, right? For me, it's Tesla because I have my highest conviction in Tesla for the long term. So to answer your question, by the way, market's really rolling over here. We're going to take a look at, when Jerome Powell starts talking in just a minute. But to answer your question, when I'm building out a new position, so for example, end phase right now, the question that I'm trying to ask myself is, okay, how confident I am in that company for the long term. And for end phase, I'm pretty confident, right? On a scale of 1 to 10, I would put Tesla at like an 8 or a 9, and I put end phase at a 7, right? So maybe just a little bit under Tesla in terms of my conviction, my confidence over the long term. So that's the starting point, right? How convinced I am, how confident I am in my thesis, and you gotta have somebody that kind of plays the devil advocate. Our community does a great job in kind of pointing out, and this is a specific stream I did. If you guys remember correctly, like last month, we did a specific stream going over why not to invest in end phase, right? What are some of the reasons why we shouldn't look into end phase? Why? What is wrong with end phase, right? What could possibly go wrong with end phase, right? This is just an example. So once you've got your established thesis, then again, you figure out that percentage, your target allocation, and then you figure out your pricing of the trade, right? What's your fair value and where you're comfortable buying and starting a new position. And then you go about slowly and steadily kind of dollar cost averaging into that position. One thing to remember is that you obviously don't want to be DCing in. If you're investing, you don't want to be DCing in on the way up. And instead, you really want to be DCing in heavily on the way down, because that's what really moves your cost basis lower. If you're investing and if you're dollar cost averaging on the way up, you're really moving your cost basis closer and closer to the market price. And the opposite is true when you're trading. So when you're trading, you want to be dollar cost averaging. If you haven't built your position size yet, let's say that you want to go in with, let's say, for example, 500 shares, and you got in with 100 shares, 200 shares, and the stock price starts moving higher. And this is for a trade. That's when you want to be dollar cost averaging a little bit higher as you're getting that confidence, as you're getting that confirmation for the trade working in your favor. But you don't want to do that on the way down when you're trading. If it breaks down that support, you want to be getting out, you want to be cutting your losses and moving on to the next opportunity. But when you're investing, there's going to be volatility. Stock price is going to move up and down all over the place. And sometimes it's going to be trading below your average cost. Sometimes it's going to be trading higher. But the point is to build out that position, get to your target allocation, and where you feel comfortable owning the shares based on your conviction level on the stock as well. So hopefully that gives you a little bit of an idea of what I like to personally do. But 75% is made up of TPL, Apple, and Tesla. Man, we've got some super high conviction Tesla people here in the chat. 65%. Oh man, I love it. How to start building portfolio if the ticker price are higher, like Tesla, Nvidia? Mank is asking. So are you saying like meaning that it's higher than your fair value, or are you saying that it's just expensive? Because either way, I mean, there's over 7,500 stocks out there. These two companies aren't the only ones that we have to look at. So there's a lot of other opportunities, and I'm sure you can find something that gets you excited other than Tesla and Nvidia. And I know like these are the big high growth companies and the tech companies that everybody wants to own, but I'm sure there's other opportunities as well that are worth looking into. Anyway, so we are going to be ready here in any second. I'm going to do an audio check, so just let me know if the audio is working well, okay?
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Steve.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting. And as we go into each meeting, we're going to be asking ourselves the same questions. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path it will be consistent with the CPI reading. But we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture. And starting with, we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation. And we'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index. And lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen We've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Gina. Thank you. Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. You know, we've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder from your perspective, if that continues, if we see growth not just stabilizing, but doing, you know, performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Neil.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS looks good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations. And as a result, we went ahead and took another step. And that's, you know, a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but, you know, we're going to be careful about taking too much signal from a single reading. And, you know, growth came in stronger than expected. So that's how we look at it. And so we did take that step today.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, you know, how much of this and how much of that. You know, we'll be looking at everything. And, you know, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data. And that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, you know, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you were really, sorry, what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the two risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headline's going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and that's the thing we really need to avoid and will avoid.
Michael McKee.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Colby.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down, the point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
Thanks. Howard Schneider with Reuters. Among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy, and there are those who feel, they say it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags, plural, that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has repeatedly proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data, and given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is, the growth rates edging down towards and below, heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source, but I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this SLOOS will say.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So, interesting question. So, let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply, both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
See, and just to follow up, do you think that of those two sources, the core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward.
Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey has, it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector in the last, in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike. And the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level. And
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates? Or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on the whole, on a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year, and that's just going to be a judgment that we have to make then, a full year from now, and it'll be about how confident we are that inflation is in fact coming down to our 2% goal.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for a recession. And I'm wondering if the staff has changed its view on the likelihood of recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view. And I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast, but given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we as FOMC participants produce. Having an independent staff forecast as well as the individual participant forecast is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us make, informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway. And yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market. And that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions. And consistent with having a soft landing, you would have some softening in labor market conditions. And that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
All right, everyone, so that's going to be it for today. It's a little bit past midnight here in India, so I'm going to share the link in our Discord if anybody wants to keep watching, but very, very vague answers from Jerome Powell, as always. We're not getting a lot of specific guidance on what the plan is, so it's just going to be meeting by meeting. It's a little shot in the dark at the end of the day because, as, again, answered by Jay Powell, it's meeting by meeting. That's all it is. They're going to make decisions based on the incoming data and literally give us no guidance whatsoever, zero. So I'm going to do an updated video and analysis on today's press conference. As always, hopefully you enjoyed this stream, and make sure that you drop a like, subscribe to the channel. And again, do check out the links in the pinned comment, because we are going to so the discount codes are going to expire at the end of this month, so we are going to get rid of them. So coupon code LAUNCH for the option scores, 50% off. And of course, the Discord currently does also have 16% annual discount available till the end of this month. So again, you can access all the benefits, binds alerts, options alert, video library, lectures, tutorials, intrinsic value, trading view charts, and a lot of other private community member benefits as well. Member-only videos, and of course, tutorials and lectures as well. So thank you so much for joining. As always, happy investing, and I will see you all in the next video. Take care, everyone.